Buying and selling a home can be an exciting yet complex process, especially when it comes to understanding the tax implications involved. In Canada, various taxes come into play during the purchase and sale of residential properties. To ease the process and ensure that you're well informed, this article sheds light on some crucial tax aspects that you should be aware of before engaging in any real estate transaction. When you purchase a home in Canada, you are typically required to pay a land transfer tax, LTT, to the provincial government. The LTT is calculated based on the property's purchase price and its location. Each province has its LTT rate, so it's essential to research the applicable rates in the province you're planning to buy property. In some jurisdictions, first-time homebuyers may qualify for a land transfer tax rebate, which can help offset some of the costs associated with purchasing a home. Another tax to consider when purchasing a home in Canada is the Goods and Services Tax, GST, or the Harmonized Sales Tax, HST, depending on the province. Generally, the GST/HST applies to new homes, extensively renovated homes, and newly built rental properties. There are various rebates and credits available for first-time homebuyers and those purchasing new or substantially renovated residential properties. First-time homebuyers in Canada may be eligible for the Home Buyer's Tax Credit, HBTC, a non-refundable tax credit corresponding to 15% of the first $5,000 spent on purchasing a home. For instance, if you spent $5,000 on the purchase, you could claim a $750 tax credit. To qualify, you or your spouse must not have occupied a home that you or your spouse owned within the 4 years before this purchase. One significant tax advantage for homeowners in Canada is the Principal Residence Exemption, PRE, which allows Canadian residents to avoid paying capital gains tax, a tax levied on the profit when you sell an asset, when they sell their principal residence. To qualify for the PRE, you must have owned and lived in the home as your primary residence for at least 1 year before the sale. It's important to note that the PRE applies only to one property at a time. If you own multiple properties, you must designate one as your principal residence. To maximize your tax savings, it's a good idea to designate the property with the highest potential capital gain as your primary residence to reduce the taxes owed upon sale. Starting from 2016, the Canada Revenue Agency, CRA, requires that all sales of a principal residence must be reported on your income tax return, even if the sale is entirely exempt from capital gains tax due to the PRE. This measure is to ensure that any gain on the sale of a property not eligible for the PRE is adequately reported and taxed. Failing to report the sale of a principal residence may result in penalties from the CRA. Understanding and navigating the tax implications of buying and selling a home in Canada can be a daunting task. It's essential to educate yourself on the different aspects to ensure that you're taking advantage of available credits and exemptions while staying compliant with the CRA's tax requirements. Consulting with a tax professional or real estate agent can also be helpful in making this process smoother and more manageable.